Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have CEO Mike Walkinshaw from Timia Capital. Timia trades on the TSX Venture Exchange under the symbol TCA and on the OTC under TIMCF. The company is currently trading at 40 cents with roughly 60 million shares outstanding for about a $24 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Great to have Mike back. We've had a couple calls in the last little while. It's the first time to introduce you directly to our audience. Timia is a company that actually came up in one of our cheapies with the chance list, so we know somewhat enough about you guys, but really want to get to know a lot more about you guys, and I know our audience certainly does. Mike, welcome today. Tell us all you can about Timia Capital.
Wonderful. Thanks, Paul. Thanks, Trevor. So Timia Capital has been around about 6 years, and we fundamentally believe the private credit industry is just ripe for innovation. And so we have built a technology platform that we believe will revolutionize the private credit industry and deliver the fruits of those efforts to common shareholders in our company. So I'll step you through the presentation today. Paul, I certainly don't mind if you stop me in the middle of any of these slides and ask questions. And I know we'll have a quick Q&A at the end. So the private credit industry has been around a long time, but has been really the purview and domain of high net worth investors. It has a certain opaqueness to it that has not lent itself well to the ability to be able to let smaller investors in and to deliver the kinds of returns that the industry has been able to deliver. But as certain recent events, like say bridging finance, have indicated, the industry is not operating at peak efficiency, and we fundamentally believe that we can revolutionize that industry. And so we have been able to, through the technology platform we've built, and I will step you through some of the pieces of it, been able to deliver superior investment returns, which primarily comes from higher quality deals and higher returns, all driven through the technology platform. We run more efficient operations than most private credit companies, primarily coming from lower operating costs in the markets that we operate in, as well as operating in spaces where others really cannot, by keeping those operational costs down. And finally, we run a more effective fundraising operation from our capital providers by providing transparency to our yield investors. So that would be high net worth individuals who invest into our limited partnerships, or institutional investors who take a direct position in some of our portfolio companies. Important to note that as common shareholders, what you're looking at investing in is the technology platform, not the pool of assets. We source all of the capital to fund the private credit investments that we make through institutions and investors who are interested in earning yield, not necessarily in earning the capital gains upside. What we're here to talk about today is the capital gains upside that can come from investing in the platform that we're creating. So now let's put a little meat on the bone in terms of exactly what it is we do. So Timia Capital, as an origination platform, we originate, we underwrite, we service, and then we fund. We find funding for the loans, and we fund the loans, and we manage that portfolio. Now that in and of itself is absolutely no different than what any other private credit organization would do at the highest level. However, how we do each of these underlying functions of the business is dramatically different and dramatically improved over the old model. So we have a proprietary tech-enabled platform that originates high-performance borrowers all across North America. We have a quick and efficient cloud-based automated underwriting process that specifically runs off of scorecarding that others don't have. We continuously track the financial metrics of the underlying portfolio companies through automated data transfers directly from their GL and from their bank, which gives us access into the inside of the underlying portfolio in ways that most private credit organizations don't have. And above all, because of all of this, we're able to generate above average returns, which makes our fundraising a heck of a lot easier when it comes to finding yield investors. And moreover, a portion of that return is shared with the management company, which is Timia Capital, the public company. And so as common shareholders, you share in the above average return that we're able to achieve through our underlying management fees and carry and ownership of the underlying businesses. So a little more specific on some of those underlying changes. So the standard private credit industry model for each of those fundamental tasks. In the old model for the origination of private credit deals, it's often done through referral networks, it's done through paid agents, and it's done through more mundane things like going to trade shows and interfacing with entrepreneurs or lawyers or accountants or others who might have access to some of these deals. Our model is to use the new online marketing tools that have been developed over the last decade and to apply that into the private credit model. And so we run a very detailed and advanced online marketing campaign that target specific entrepreneurs in specific parts of the country, the continent, I should say, and get ads in front of them to help them solve their financing needs. And so if you go to our LinkedIn page, if you go to our website, you see a lot of information, content-driven information that is appealing to entrepreneurs. So information on how to help them run their businesses better. That's very detailed on the specific sectors that we service. And as a result, we're able to build a relationship with these entrepreneurs. And when it comes time for them to need financing, they come to us more often than not. And so we're able to bring in deals cheaper. We're able to bring in a much wider area, geographic area, and cover that area more effectively. And we're able to get higher quality deals because once we have that kind of broad geographic scope and high volume of deals coming our way, we're able to down select to the best deals and only do the best deals. And that has resulted in very, very strong returns for our private credit operations so far. In the underwriting process, we use scorecards actively in our process, and we build those scorecards specifically for the industries that we service. We don't just use the generic debt service multiples or other kinds of private credit multiples. We actually build industry-specific multiples and get those multiples analyzed. We use online access to the company's underlying GL and bank accounts to be able to pull that data up rather than having financial analysts rekey data or do Excel spreadsheets. It all comes into our system and we're able to deliver a credit score for a company within an hour of data upload. So we do a significant amount of more advanced data transfer and analysis on an industry specific basis. And that gets us better, faster, and ultimately cheaper in terms of our ability to be able to deliver these services. And then the servicing of the portfolio, which is the ongoing month-to-month monitoring once you made the investment. Many private credit organizations just run on PDF financial statements emailed over from the underlying company. It's typically done quarterly, and it takes a month for somebody to look at the financial statements. And so it's really 3 or 4 months before you figure out if you actually have a problem in your portfolio, which is often too late. We take financial data out of the underlying companies, automatic, up into our system, run them through our credit schemes and our scores every single month, and we have a look. And if one of our portfolio companies is tracking poorly, we are able to ID those problems earlier and take action earlier, which has resulted in a very, very low loan loss ratio in our portfolio. So getting that data and automated transfer, setting up the system, and then building out those covenants and those calculations that you want on an industry specific basis are very, very important for us in being able to deliver higher returns to investors and thus higher returns for our common shareholders. And then finally, having built all that platform, we're able to use a lot of those same technologies to be able to fundraise from yield investors. And so that's online marketing, that is transparency. So being able to show an yield investor what their pool of assets is something that, although it's hard to believe, has not really been popular in the private credit industry. So we're able to show you're invested in this fund. This fund has these 25 investments. Here's some very simple metrics on this, how those 25 companies are performing, and you're able to sort of follow along and find out what's going on with your investment. That has been very, very compelling in the fundraising industry for us. So those are really the nuts and bolts of how we do what we do. And all of it comes together in what we describe as a platform. And that platform is what we've been investing in for the last 6 years building, and we continue to build on a go-forward basis. Now, mechanically, we have two different companies under Timia Capital, the public company. One of them is Timia Capital, which is a technology lending company focused on lending to technology companies across North America, 50,000 plus companies across North America. That sector is growing at 25% per annum. And by and large, these companies just can't get financing from a bank because they don't have a lot of assets. But what they do have is contracts and committed monthly revenue from their customers, and a tremendous amount of growth. And so we have built over the last 6 years a scorecarding system that we think is world leading in our ability to be able to look at any kind of technology company, decide if it's a good bet or not, and to quickly deploy capital into that company and then manage it out to the end. We have done 50 deals over the last 6 years. We have never had a default. We have never had any significant write-downs, and 20 of the companies out of the 50 have paid out and returned capital to investors. On that basket of companies, we have delivered gross returns that are north of 20%, which is a combination of the underlying interest coupon plus the bonuses that we receive at buyout. That has translated into returns for yield investors who have funded those investments of somewhere between 13, 14, 15%. And the difference between the gross return and the net return that we're paying yield investors is what Timia Capital, the public company, uses to both fund its operations and ultimately deliver profit to common shareholders. So that's that business. And that business was growing nicely through the last 3 years, having grown at roughly 30 to 40% per annum in terms of assets under management, while maintaining that kind of spread that I was talking about. But we decided that we had an asset, and that asset was this technology platform. And so we decided we needed to get out and acquire other businesses that could benefit from our technology platform. And so on September 21st of 2021, we closed our first acquisition, Pivot Financial, which is an Ontario-based asset-backed SME lending organization, roughly the same size as us in terms of assets, but very lean, and was looking for somebody to partner with who could provide the back office engine and the automation systems that we have. And conversations progressed, and we realized this would be a great merger for us to be able to apply our platform to their operation and help them improve their efficiency and their spread, and for them to bring in a brand new business vertical and operations in Ontario that certainly extended our own operations. And so those two came together, and our analysis of the acquisition was certainly that it would be accretive immediately And as we move through Q4 here, although we haven't announced our results, we're very, very happy with how that company has added on to our existing performance, and look forward to disclosing those Q4 results in the next month or so as we get through our audit. The size of the company, or the size of Pivot specifically, is about $100 million of assets under management. 52 or $53 million of those are direct loans. They have about $45 million of lender finance, which is loans to other lenders, and some small factoring operations. Their combined assets under management plus our assets under management add up to about $140 to $150 million of assets under management right now. So having put the two together as if we were one company, which of course we were not, so I just want to put an asterisk on this chart, but having put the historic operations of these two companies together on one chart as if they were one company, you can see the substantial growth we've had in assets under management since 2018, from just in the mid 30s to upwards of 100 and $140 million as of September 30th, 2021. And we certainly expect that growth to be continuing. Now, why are assets under management important? They are important because for every dollar of assets under management, there is a certain percentage that flows to Timia Capital Corporation if we continue to operate as we have been. And that percentage is somewhere between 4 and 6% of every dollar should flow to Timia Capital on an annual basis as our share of the return on those loans. And that, as I said earlier, is what covers operational expenses and growth. And historically, and certainly continuing forward, the growth of assets under management combined with that share of revenue has definitely been growing faster than any operational expenses that we've been growing in. As such, we have moved from burning cash in the first 2 years of our existence to break even, and now looking forward to moving into throwing off significant positive cash flow for our investors on a go-forward basis. So the revenue growth of the two companies combined, you can see in 2020, had we have been operating together, we would have been an $11 million organization, and certainly expecting to exceed that in 2021 and continuing to exceed that at an even faster pace into 2022. The management team is an experienced group of venture capital and private credit veterans. I myself worked in the equity venture capital space for many years. When I started Timia in 2015 with Greg Smith, formerly of Espresso. Andrew Avishar is another venture capital veteran from the Canadian venture capital space as well. He ran Tech Capital, started and ran Tech Capital. He's a CA, we're both CPAs, and he's a CFA. He's our chief credit officer, our chief financial officer, and he's based out of Waterloo. Ken and Dan both came to us through Pivot Financial, and Ken was the entrepreneur that started up Pivot and grew it to what it was. Dan is I call him a crusty credit guy who comes out of multiple different credit organizations and is the guy who's making the real hard decisions on credit operations on Pivot's side of the fence. And definitely the Pivot team is excited to have more bench strength from the Timia team to be able to help them do the analysis and to automate the processes that they're currently doing, have historically been doing manually. Brooke Jutzi, VP of Finance, comes out of PwC. You can see we have PwC logos across the board. Three of us are PwC vets. And Rob Foxall has been leading our origination since day one, formerly from Espresso, and is well known across the Canadian tech community as somebody who can be financing companies using debt in tech spaces. So capital structure, as mentioned earlier by Trevor, 60 million shares outstanding, about 70 million fully diluted. That gives us a market cap of around 24 million. We do have 10.5 million preferred shares outstanding, and that a number of those shares actually were used when in the acquisition of Pivot. and we will and do have the right to start retiring those over time. So we will be using the cash flows in the business to be paying down those preferred shares. We do have some warrants outstanding, but nothing significant. And we do have some options outstanding. We have an option pool, just about 4.75 right now. Insider ownership is big between myself and Andrew and Ken, and to a lesser extent, Dan. Significant shareholdings, 4, 5, 6 million shares each, as well as the board members of the company who all have been investing through the organization. They have been investing as both shareholders as well as yield investors, using different sort of aspects of their own capital trees to invest in the company. We did announce an NCIB back in March of 2021, and we have been working our way through the year, supporting the stock here and there along the way. We found that to be a very useful tool. And we're not active right now with the NCIB, but as the price continues to move around, I think you'll see us continue that program. So just to summarize, you've got a management team here with over 40 years of investing experience in all kinds of different situations: private equity, private credit. You've got CFAs, CPAs, and you've got technology people who've been able to apply it all together into one package and deliver it into the marketplace. We have built and spent the last 6 years building and investing in a technology platform that is leading in the world in terms of our ability to be able to source, evaluate, manage private credit investments. And we've been able to bolt on transparency for our investors, which has improved our ability to be able to raise money from yield investors along the way. The Pivot acquisition in September scaled us up and got us to a level where we went from sub cash flow break even to above cash flow break even. And I think you could expect us to continue to look to scale assets under management utilizing the technology platform that we have. And even organically within the existing businesses, business has been accelerating. I think as we've come out of COVID, a number of companies that were receiving funding from government funding programs, that has slowed up, and companies are coming back to the normal funding sources. And so we have seen some significant acceleration of quality deals coming into our shop in the last 3 months that we've been working hard to push through the pipeline and fund. So with that, I'll leave it, and happy to get into the conversation.
Perfect. Thank you, Michael. One thing that came to the top of my head, and I didn't see it in there, but the loans that you provide, these deals you provide, typically, what's the term length of these?
So for the Timia Capital technology lending side of the fence, it's 2 years to 5 years. We will do 2-year interest-only loans with a bullet repayment at the end. For anything that's more 4 or 5 years, they're paying down principal over the life of the loan, and they may pay down the entire principal, or there might be some small bullet left at the end. But we typically take pay downs over longer periods of time and interest only on the shorter end of the spectrum. On the Pivot side of the fence, it's a much shorter business. Those typically are 12 to 18-month loans. They are asset backed, and they are often for companies that are in the process of reconfiguring some aspect of the business or sorting some issues out, and they're looking for shorter term financing to clean things up and then to move on to more traditional financing sources.
And give us a sense of sort of the supply demand. Are you guys having a hard time finding companies to lend to? Are you having a really easy time and you'd rather have a lot more money? Just give us a sense of the sort of the landscape right now for what you guys are doing.
Yeah, there is a pendulum swing to the business that is natural there, where sometimes there are more deals than there is capital, and then there are times where there is more capital than there are deals. So on the technology lending side of the fence, at this point, we're seeing more demand from the deal side than capital. And so there's a bit of a catch-up phase there for us in terms of launching a new LP vehicle to get out and put money in the bank for that.
And what can you tell us between the pivot and the Timia side? Where do you see sort of stronger growth? What does the future look like in those two different areas?
That's an interesting question. So with the pivot, with the Timia organization, I think we're continue to see 35 to 40% annualized growth in terms of assets under management. That said, we have had a tremendous fourth quarter. As I said, I think driven by the government programs that have been funding companies starting to sort of dry up both south of the border and here. So the kind of growth we've seen in Q4 is definitely higher than that 30 to 40% growth rate. Pivot is only Ontario based at this point, and so they tend to sort of ride with whatever the Ontario economy is. And so I think their growth varies quarter to quarter much greater than Timia does. So I would say, that said, to be fair, Pivot has grown over the same period of 6 years. Pivot had grown to $100 million and Timia had grown to about $45 million. So Pivot has had a higher growth rate from its initial start, which was roughly the same time as when we started.
So you mentioned sort of your funding vehicles. You sort of sell LPs. Maybe give us some details of that. There might be some people here interested in participating. What does the tradition, sort of the terms typically look like? What's the length of holding, stuff like that?
Yeah, so we fund through Canadian limited partnerships. The most recent limited partnership that we are just putting together has two classes: a senior class, 70% of the assets funded by the senior class. That is a 10% return, and it is senior to a junior class, which is 30% of the assets of the fund. So the senior yield holders have a much higher percentage chance of getting their 10% return based upon the protection that they're receiving from the junior class. The junior class, of which Timia will hold 1/3 of the junior class at all times, is available to external investors. It obviously has a much higher risk profile, but the return expectations there are 17 or 18%. So that is if we can deliver the historic return we have delivered in the past, which I would fully expect based upon what we've been able to do in the portfolio we've been able to build. We should be able to deliver those returns. However, investors need to understand that is obviously subordinated below a 70% senior layer. So there's kind of a menu of items that investors can choose depending on their risk profile and the kind of return expectations they'd like to see. What's new is the new fund is an evergreen fund, meaning that there is no repayment of principal as deals redeem. However, there are redemption provisions that I think would be considered fairly standard. And the vehicle is also RRSP eligible. So individuals who have TFSA or RRSPs can bury these investments in those and protect the interest income nature of it from tax. Should say that it's only available for accredited investors at this point. It's not broadly available, although it will have a fund serve code and be available through broker platforms, but only to accredited investors.
Gotcha. Okay, so I noticed you guys have a financing, sort of an open financing right now. It's been upsized to 2.4 million. What are the use of proceeds? Why are you raising money right now?
So we were approached by an institutional investor, somebody who's in the private credit space, not specifically an equity investor, who was really interested in our business and is somebody that we have a lot of respect for. They wanted to invest in our business to the tune of a $1.5 million equity investment. So we talked about it at the board level. We didn't really need cash, for example, on our balance sheet at this point because we're cash flow break even and we're not really burning cash. So, but we did want this investor involved in the business. So we brought them in and we decided it would be good for broadening our story if we were able to bring in some new brokerage investors along with that. And so we embarked right just before Christmas and just at the early part of this year, and bringing on some new broker investors to up that to what is currently about $2.2 million. And we'll be closing that out in the next, really close, like early next week, we'll be closing that out and announcing the final close.
Gotcha. And the other thing I noticed is you guys do pay a dividend. Is that a special dividend or is it an ongoing dividend?
So the dividend is only paid on the pref shares.
Oh, okay, gotcha.
We do not pay a dividend on the common shares. And this is a topic of a lot of conversation. I think down the line, we're going to have some capital allocation decisions to make at the board about what's the right thing to do with cash proceeds flowing in from operations, and whether we should be using that in expanding internal operations and investing in deals, or whether we should be paying a dividend. I think at this point, investors should probably expect us to be leaning towards reinvesting those proceeds in the business.
Fair enough. Okay, so you purchased Pivot. I mean, is there more M&A in your future? Or is that something you guys are actively looking at? And if so, what sort of areas would you be more interested in?
So we are looking at continuing activity on the strategic front. Absolutely. There is a realistic upper threshold for how quickly we can move on any of these transactions, because it does take a lot of effort internally to be able to integrate existing operations, and you don't want to run down the road too fast doing further acquisitions. But our strategic criterion for future acquisitions are we like specialty niche focused credit models that have some demonstrated expertise in a very specific area. We need those businesses to benefit from our technology platform. So in other words, you won't see us invest in somebody else who already has their own technology platform. You're going to see us only acquire other companies where the technology platform can instantly provide benefit to that company and help us generate extra profit from those operations. And third is going to have to be accretive to our operations, which sort of with this public-private arbitrage that's sort of available, I think you'll find accretive we'll be able to find a lot of accretive operations. So it's going to be a contemplative pacing of continued growth, which is going to be a combination of both organic internal growth, but also the odd strategic transaction down the road, I think.
The one thing I should have asked a little earlier is just sort of talk about a bit about the competitive landscape. Now, what we've seen some other companies that are somewhat similar to what you guys do, but usually the ones we've looked at, when they lend money, they tend to get some sort of leverage or upside to their lender's business. But you guys don't do that. Maybe explain why.
Yeah. Well, one of our taglines is keep more of your business. So when we were, that's what resonates strongly with the entrepreneurs. And so we have always, in the early days, we did ask for warrants or other sort of equity positions in the underlying companies. And it was always it was never really well connected with our marketing message. The second reality that I fundamentally believe is, having been in the venture capital game for many, many years, and having done some very deep statistical analysis on this, getting warrants in these underlying basket of companies is not ever really proven to be worth the effort and or time and or marketing problems that it has created. So the one thing to keep in mind is that we're not looking at the same basket of companies that venture capital players are. They are trying to find the 1 out of 100 that is going to go public on the NASDAQ. We are doing the middle 50. That's the companies we're funding, because we're providing debt to entrepreneurs who, they don't want to go public on the NASDAQ. They want to sell their company for $50 million in 4 years. That's what they want to do. And that exit profile has absolutely zero interest to the venture capital community. Whereas for us, that's great. And so those warrants, when analyzed statistically in any kind of a Monte Carlo analysis with that kind of a profile, you come to the very quick realization that, putting a lot of effort and time and money into warrants and equity is just not worth it. It doesn't add anything. And so we actually structure our buyout provisions to pay cash. And that's where I made a comment earlier about how our gross returns have been 25% gross IRR on the portfolio. Our average coupon rate might be 17 or 16.5%. And the delta between the 16 and 17 and the 25 is cash payments that come from, if somebody wants to buy out of their loan 2.5 years out of a 4-year cycle, there is a payment that goes with that. And so that is what drives those extra returns. And so we made a decision very early on that cash payments were where it's at. Now, all of this is in relation to Timia Capital. Pivot has never chosen to go after equity positions in companies. There might be a more natural fit for that. It is something we will look at on a business by business basis based upon the underlying characteristics of the exact industry. But at this point, it is just proven to be counterproductive to our overall returns to go for those kinds of instruments.
Michael, what sort of keeps you up at night running this business?
Well, so macro environment things really keep me up. So I got a question I get a lot is, what's the impact of rising interest rates on this business? I do fundamentally believe that there is a top end interest rate that is, viable from an entrepreneur perspective. So our ability to be able to move our interest rates up as base interest rates move up is, I think, capped out a little bit. I think there's a little flexibility there, but for example, right now we might charge, say, 16.5% over a 4-year facility. If interest rates were to go to, base interest rates were to go 7%, we wouldn't be able to charge 23%. So that's one thing that I think I continuously work on, continuously keep my eye on. I think the other thing that keeps me up at night that I spend a lot of time working on is making sure that as we grow, our business is a system-based business. It's a process-based business. And as we grow, it's harder for the management team to keep their finger on the pulse of every single deal that's coming through. So as we get bigger and bigger, and we are getting bigger and bigger, we need the systems that we have built to do what they're supposed to do. And so I worry fairly consistently about whether there are any things that are getting changed in the system that could kick out 3 or 4 bad deals before we were able to really realize that these are bad deals. And so we're very, very rigid around any sort of change to system, any change of the scorecarding, any change of inputs. And we have a lot of protection and control. Of course, we're chartered accountants. We have a lot of protection and control over how these things are changed and any sort of implementation of any changes. And that is one thing that, I'm sure most people who aren't in a business, and specifically in our business, don't necessarily understand, but you're putting a lot of trust in a system, and that system had better deliver. So it's really up to us to make sure that the system works and delivers what it's supposed to deliver.
Okay, Michael, take out your crystal ball. 5 years down the road, what does Timia Capital look like as an entity?
Yeah, I think without going offside any securities regulation, what I really think is the opportunity for both the yield investors and common shareholder investors is that private credit is becoming a far more common and viable thing for a much broader spectrum of businesses that couldn't access it before. And I think, as most of our investors here are probably Canadian, we're all used to the Canadian banking system, but there are equally large problems with the US banking system. And as such, I think a lot of businesses out there can access credit in ways that, some maybe larger businesses or other classes of businesses can. That's changing. And so, our growth is not going to be to grow any one vehicle that we have to $1 billion. Our growth is going to be to grow the number of vehicles that we have each utilizing the technology platform that we've built so that we stay specialized. We earn excess returns from those specialized verticals. We are able to apply detailed technical scorecarding into that specific sector, utilizing specific industry metrics that, you know, a generic private credit fund could not. And we're able to benefit, you know, both from the common shareholder and from the yield investor perspective. So I think what you'll see 5 years from now is Timia Capital might have a couple billion under management, but it's not going to be in 1 or 2 companies. It's going to be in a number of different companies, and we're going to have a menu of specialized brands offering product into specialized markets, and they're just going to be excellent at what they do in that one market. I think that's what we're going to look like.
Perfect answer. Okay, so as investors on our side here, when we're looking at Timia, what sort of metrics or catalysts? You know, it's easy to say, okay, to follow your business, revenues are growing, and that, you know, that's a KPI we can follow. But what else? What other sort of metrics or catalysts should investors be watching out for to sort of validate that you guys are continuing to execute in your business?
Yeah. So, and this, you and I had this question and conversation a couple months ago, even, and I've even done more thinking and work on it since, especially since, you know, we've been evaluating a lot of other lending platforms out there. So revenue is absolutely one, but one of the things that I think is really interesting is sort of working your way through any lender's income statement is total revenue divided by the weighted average assets under management through the period. So that will tell you what their average yield is, and that's not just coupon. That includes transaction fees, it includes carry, it includes all these other sort of like different kinds of revenue. But what is their average yield that they're making on an investment? And then the next layer is what we call finance spread, but what really looks like gross margin on an income statement. So if you're making 16%, but you're paying somebody 15%, you're only making 1%. Well, maybe that's not such a great business. If you're making 16%, you're paying somebody else 9%, you're keeping 7%. Well, that is a pretty good business. So pulling apart these lenders out there, really what we call finance spread, in relation to the assets under management and the growth of that assets under management is really something that we find to be very, very compelling in terms of figuring out, you know, whether this is a business that's interesting to us. And so when we are having our quarterly board meetings, is really we're focusing on those metrics, which are, you know, is our spread, how's our asset base, is our asset base growing, and what's our spread like? And, you know, implicit in the spread calculation is, are you losing money on your loans? And that's definitely going to hit your spread. So if somebody's making bad loans, they're going to have a bad spread. So you may have to make sure you get your ECL provision into those calculations. And then the last thing is definitely how much money are you earning for common shareholders? So working your way through all of these different lending companies, there's about 3 or 4 different ways to reflect the income statement. Some have assets on balance sheet, some of them have off balance sheet, and they're just management fees, a bunch of different ways to do it. But at the end of the day, you got to come down how much cash are you throwing off for common shareholders. That is one thing that's very important. It's something we've been focused on for a long time, and very proud to be cresting through that break even, where we're now going to start making money for common shareholders after growing this business as we have.
Fantastic. Michael, I've run out of questions. What we usually do at this point is we sort of turn the mic over to you and leave you with any ability to bring out any kind of parting message or key takeaway you want everybody to walk away with today.
One thing I would say that has been interesting to me, we live on the private credit, private equity side of the fence, but we also live on the public market side of the fence. And one thing that has confused me, I think, is how much interest and heat there is on fintech on the private side of the fence. If you go through any private equity or venture style website and you look at the big rounds of investments that have occurred over the last 4 years, really, there are a large number of billion-dollar rounds of fintech companies. that has not translated particularly well to public markets, and certainly not to the TSX venture. So one of the things I would encourage the group to do is to, if you're actively looking at us, I would encourage the group to go and look at some of these private equity, private rounds that have led to some large valuations and some very large investments, and hold us up against that, because I think we very favorably compare to what's going on the private side of the fence. And I would argue that we're relatively undervalued given what is going on the private side of the fence in terms of innovation in the whole financial technology vertical.
Mm-hmm. Yeah, no, I agree. One of the downsides of being a small micro cap on the Canadian exchanges is you get lost, certainly get lost in the shuffle there.
Yeah.
Well, listen, this has been great. It's always great to catch up with you, Michael.
Yep.
Want to appreciate the time you spent with us today. We've been speaking with Michael Walkinshaw, CEO of Timia Capital, symbol TCA on the Venture Exchange. Michael, thank you, and look forward to catching up with you in the future.
Yeah, Paul, I really appreciate the time, and thanks to everybody for listening. And I really appreciate the time they've given us today. So that's great. Thank you.
Bye for now.
Okay, bye-bye.